Hi, good morning, everybody. Welcome to Sangam India Limited Q4 FY24 earnings conference call. We have on the call Mr. Anurag Soni, Managing Director, and Mr. S.N. Modani, Vice Chairman of Sangam India Limited. I must remind you that the discussion on today's call may include certain forward-looking statements and must therefore be viewed in conjunction with the risk that the company faces. May I now request Mr. Anurag Soni to take us through the company's business and industry updates. Thank you, and over to you, sir.
Good morning, everyone. Thank you for joining us today on Sangam India Limited Q4 and FY24 earnings call. Our earnings presentation and results have been uploaded on the exchanges, and we hope you've had the opportunity to go through it. Before we delve into the financial performance highlights, let me briefly touch upon the industry landscape and strategic updates for the Q4 and FY24. I'm pleased to announce that there has been an incremental improvement in the business outlook. We are implementing strategies to reduce cyclical volatility. As the sector headwinds have reduced a little, we are witnessing a slight uptick in demand, reflected in improved price realizations across all our product segments, and our quarterly profits have seen a smart recovery. Today, we are strategically positioned as a premier textile manufacturer, recognized for exceptional quality and diverse product offerings. Our strategic focus has always been on providing tailored solutions to meet the distinct needs of our customers. Having complete control over the production from yarn to fabric and garments, we are able to meet the demanding specifications of the customers and deliver the highest quality products and make in-time deliveries. The company has been moving up the value chain and increasing the proportion of fabric and garments. Currently, 53% of our product mix comprises of value-added products, and going forward, we are committed to increase this further. During this quarter, there has been an improvement in capacity utilization under all the segments of the company. Our capacity utilization reflects our operational efficiency and our ability to cater to higher demand. Now, I would like to hand over to Mr. Modani, sir, to provide further insights into the strategic updates for the quarter.
Thank you, Anurag. As you are already aware, we are a prominent player in this industry. Our company has legacy spanning over 40 years in the textile industry. Our strength lies in our comprehensive presence across the textile value chain, highlighted by our leadership in the PV dyed yarn. The expansion into garment and fabric reflects our commitment to providing value-added products. Having said that, the company is pleased to report significant progress on several strategic initiatives. Firstly, denim and phase 1 of synthetic fabric capex has been successfully completed within expected timeline and will be yielding benefits from Q1 financial year 25 and this quarter onwards. Phase 2 of synthetic fabric is currently underway and is progressing as per schedule. Phase 3 of yarn segment is also scheduled, and it is on track for completion by Q1 FY26. Lastly, we are happy to report that Sangam India Limited received prestigious award by Texpostal for achieving the highest export of denim in the year 2022-23. During the year, we exported approximately 160 lakhs meter denim fabric across the world. These milestones emphasize our commitment to increase proportion of high-margin products and in the global arena. Now, I would hand over to Anurag again to discuss the financial highlights of the company. Thank you, Anurag.
Coming to the financial performance of the company, in Q4 FY24, our revenue showed a quarter-on-quarter increase of 13%, reaching 701 crores. EBITDA is at 67 crores, which is grown 38% quarter-on-quarter. EBITDA margin is at 10%, which is expanded about 1.7% quarter-on-quarter again. Quarter 4 net profit is at 14 crores. Lastly, I would like to say that we aim to achieve a top line of about 4,000 crores while maintaining a steady EBITDA margins at around 12.5% for FY26. With this, I would want to conclude my opening remarks. We can now open the floor for questions.
Please form a queue for the questions, and we'll take the questions accordingly. Mr. Darshil Pandya, sir, you may go ahead and ask your question.
Hello, am I audible?
Yes, sir, you are.
Yes. So, sir, what are the markets we cater to through our exports, and any new geographies or something that you are targeting? And
Well, the market actually spread all across the globe. So, like on the cotton side of the business, Bangladesh is a big market. Then South America, Latin America are big markets for our PV business. Then Europe, Turkey. In our fabric business, there is the African side. Egypt is a big market, and the Middle East is a big market. So it is spread across all geographies.
okay, have we entered any new geographies this quarter or this year?
So what we intend to do and what we are working on is that so there are various product segments in the company. So let us say we are present in a particular product and not in the other segments. So we are working on those markets where we are already present and adding our products in those markets. So that way we are adding new markets. But since we are already present in more than, I think, 60, yeah, more than about 60 countries globally. So then it is difficult to actually add more countries then.
Got it, got it. And who would be our key clients, if you can name any?
So the key clients, actually, there are again varied clients across the segment. So and on the investor presentation, we've put our major market clients on them. So there are about 30, 40 big clients that we've put on the presentation. So I would request you to look on that, please.
All right. So second question would be, are we going to increase our export for garments more or cater to primarily domestic, or which markets will be focusing more on?
See, so currently about 1/3 of the business in the company comes from the export market and 2/3 comes from the domestic market. Now, see, there is a huge potential domestically as well because India is growing at a fast pace. So we see that over the last 3 years, I think the number for exports has varied around 35 to 40%. So it around that margin because see, absolute number is going up because turnovers are increasing. So absolute numbers are growing up, but because India is also fast growing. So in terms of overall percentage of revenue to the company, it may remain in the similar range.
Okay. And so what is the mix of valued products that you are envisaging in your total revenue, maybe in future, and how much is the incremental margins that you can see in this portfolio?
See, again, we've given a guidance of that in the next 2 years we should be reaching about 12.5% margin level. So currently we are at 10%. So we should see some incremental gains quarter over the next 8 quarters.
But no, I just asked about the value-added products. What will be the share of that?
Value-added products again. So when we say value-added, we are actually saying that the contribution of yarn to the total turnover is about 47% currently. But that does not imply that we are not doing any value addition yarns per se. But then when we are saying that we are moving up the value chain, we are actually adding on the garment and the fabric side. So this number should increase. Again, every quarter we will see a incremental gain on that side. So probably over the next 2 years, this number can be about 60% coming from the fabric and garment side and 40% from the yarn side.
Got it. One last question, if I could ask. Sir, how will we be working on the debt side? Because I can see almost 1,000 crores of debt standing on the books, and we are still on the recovery phase, and I guess the interest payments will be started up. And what will be the interest cost for this year specifically?
See, debt again, our debt to equity is very comfortable. Though this was an exceptional year on the downside because the price movements were continuously on the downside, so that the margins were under pressure. So that's why EBITDA to debt can look a little higher for the current year, but they should come down again significantly over the next few quarters. Still, having said that, net debt to equity is still very comfortable. We don't see any challenges there. Interest cost wise, see, there are 2 things that have happened. One, that overall interest rates globally have gone up. So as we sit today, we are at the peak of the interest rates across the globe. So now that is beyond our control. So whatever easing will happen there, that can contribute. Otherwise, probably whatever the Q4 interest costs are, I think that is probably at the peak. So we should see a dip from here going forward.
All right, got it. I'll get back in the queue. Thank you.
Thank you, sir. Mr. Raj Mikwan, sir, you may go ahead and ask your question. Hello, Mr. Raj, sir?
Hello, am I audible?
Yes, you are.
Yeah, so FY24 had been a challenging year for exports. So, what kind of growth do you see in FY25 in terms of exports?
See, as mentioned earlier again, total percentage of exports in the company varies between about, let's say, 33 to 38, 40%. So it will remain in that zone.
Is a high challenge, and if you see during last 20 years of our carbon market history, such exchanges at the international domain were never there into the existence. So we do not think for the international trading of the credits such a.
I think that there is a I don't know. So some some cross connection that happened. Sorry.
Yeah.
I will get back to you on your question. So you mentioned that export growth. So export is about 33 to 40% of our business. It will remain in that range. So whatever growth we do in the company for the coming financial year, so export absolute number will be in line within that percentage levels.
Here
Sure.
Here I can add something, because the Sangam India is the most diversified company, and since we have a control right from the yarn, fabric, weaving, processing, and denim and all, and that timely delivery and the quantities, both Sangam has the edge because of in PV dyed yarn, because that is substitute for all polywool fabrics and all school wear and formal wear with spandex and all. So the basically company is growing, and we have a presence in 58 countries, and those countries with our business associates, because since 91 we started export. So the basically our relationship and what the market demands, we can supply with the innovative product, maybe in the blends of all made fibers, because any type of fiber blending, and that's why how we can control the cost with the product innovation. That's the beauty of the company, because we want to dye polyester, viscose, wool, hemp, linen, so whatever cotton. So basically, we are also thinking that what different product we can give at a competitive price. So we don't see there will be a challenge in exports, because ultimately, first time it has happened in April to September that PV fabric export has gone up by 2%, and we are the main forte is PV. That's why we analyze that our yarn has to be converted into polyester viscose fabrics with different blends, and then we can achieve that timeline as well as the fastest shipment possible, because market is very much volatile. Therefore, company do not foresee any problem on the export fronts. This is what I can add.
All right. One more question I wanted to ask. When you talk about value added, so what exactly it is?
When we talk about value addition means what? Like polyester is the cheapest fiber available, most sustainable. Viscose and Ecovera viscose, XL, linen, blends. When you do something different, when you go for polywool, if you can add 35, you can add 10-20% wool. And now new fibers have also been innovated by Reliance and the world over, like Airthum, Cool Max and all, which gives the effect of wool because of hollow fiber. So we are doing a lot of things because we are a spinner, weaver and all. So these are all valued items, because how you can improve the aesthetic value of the fabric, garment value per se and all. And definitely, and denim as well, because we are trying different type of yarn combinations. So definitely when you control yarn blend, and of course weaving, there are a lot of technologies involved. And so that only as a spinner we can do it. Like change in count, change in blend. So you know how to make it product more competitive and different.
And adding to that, see, by value added, we are specifically saying that we are going to increase our fabric and garment business, and overall yarn is going to be used captively, and that number will go up subsequently every year.
Okay. So 3 to 4 years from now, how much percentage of sales will come from value added segment?
earlier, see, we are saying that over the next 2 years, I think this number should be about 60%.
60% value added and 40% will come from here.
Yeah, but that does not mean that in yarn we are doing plain yarn. So even there is margin. There are products where we are making good margins, so that will continue. So basically, what we are substituting is those products in the yarn division that we are selling today, where the margins are lower, that we are going to convert further into fabrics, and that is how the margin expansion will come.
All right. Actually, how much is the cotton prices currently?
And it is around 57 to 58,000 rupees is the prices.
Per candy.
Per candy. So it is in the reasonable market. Reasonably it is because when we see the international market, Indian cotton is 2% cheaper than that, so that margin is also there, which was not earlier. It was 4 to 5% higher than the international market in 1.5 years back.
Any update on the FTA agreement with Europe?
I think UK, because the government is in election mode, so the FTA we were expecting long back from UK and Australia and all. Probably, I think after the new government will come, definitely because they are also willing to take, because India is the only source now with the huge capacities and presence. Because India's strength is what? India's strength is was in textile is the smaller lots with a design fabric. China's strength is mass, and because in the polyester and all man-made. So government, with the new government, they will work hard on man-made fiber and all to give more incentives. Because here we are stuck with the government policy because we have inverted duty structure and all, 18% on the fiber, 12% on the yarn like that. So basically that will reverse and that will improve the profitability exports of India in large for the man-made. Because the government focus has to be there.
All right. Okay, so thanks. Have a good day. Bye.
Thank you, sir. The participants may raise their hands for the questions and we will take them accordingly. Now, I might request Mr. Kush Shah to go ahead and ask his question.
Hello, am I audible?
Yes, you are, sir.
Good morning, everyone. I have a couple of questions. First would be, what are the different varieties of product under garment segment apart from C9?
See, like we are actually into some into the categories of athleisure wear, and then there is women innerwears. So those are the categories that we are present in the garment segment, and so that's present in C9 as well as the brands that we supply to. They are similar products.
Okay. Second would be the GP margin have been decreasing for FY24. Through the company have plans to move towards value addition. Please explain the disparity over here. Can you explain the disparity?
Gross profit margins are declining because, as I mentioned earlier, there has been continuous fall in prices of cotton as well as polyester side. So that's why in a falling market there are some stock losses as well that happen, and that's why the margins have been problematic and under pressures. But however, as mentioned earlier again, that we are seeing that prices have bottomed out and there is slight improvements there. So when we see December to March quarter, there is about 1.7% improvement in margins is there. So we hope that will sustain and we can improve further on from here.
Fair. My last question would be, how we have a competitive advantage over peer? Please.
See, at Sangam, we are present in various segments in the textile chain. So we are making both synthetic and cotton yarns, and then there is in the fabric as well. We are a significant player on the denim side, as well as the synthetic fabric side, and then a small portion in garments. So there is a diversified portfolio. So it is, I would say that we are better placed in terms of the varied product ranges, and when we are entering some markets where we're dealing with brands, so we are able to supply various products versus just doing one product there. So I think that is probably a edge over the other peers there.
Oh, thank you, sir. Thank you so much.
Thank you, sir. Mr. Aditya Sen, sir, you may go ahead and ask your question now.
Hi, thank you for the opportunity. So first, I would like to know if we have the breakup of the revenue from our branded products, that is C9 and the other athleisure products that you were talking about.
Currently, government constitutes about 3% of the total business.
Okay, 3%. And the capex that we are doing, is it dedicated to our branded products also, or only for the non-branded ones?
The capex that we have incurred some capex on the government side, which has been completed. So there the capacity utilization quarter on quarter. So current year we should see a substantial growth, and that is visible even when we compare March to December to March. There has been an increase in the production and the sales of the government side. So overall, the percentage is 3%, but absolute number has gone up year on year, and current year again we'll see a substantial growth there.
All right. And about FY26-27 visibility, where do we aspire our company to be in the coming years, as we are doing some significant capex? So what could be the revenue potential or EBITDA margin in FY26-27 aspirationally?
We have given a guidance 4,000 crores and 12.5% margins for FY26. So we will maintain that.
All right. Thank you.
Thank you,
That was
sir.
the question.
Thank you, sir. Mr. Saket Kapoor, sir, you may go ahead and ask your question. Mr. Saket Kapoor, sir.
Yeah. Namaskar, sir. And so thank you for this opportunity. So firstly, when you are providing a target top line of 4,000 crore for 26-27, taking into account the capex that we have done for the preceding this financial year, what should be our projected top line for this current financial year, 24-25?
We can expect about around.
Sir, can't hear you, sir.
We can expect about 15% growth in the current year with whatever capex that is kicked in, and some normal growth. So I think 15% is a reasonable number we can expect.
Okay, and in this 15%, what would be the mix between our commoditized product and the value added? Will there be a significant change, or it will be in line with what the last financial year was?
So as I again mentioned that we will see there will be so currently 47%, 5 will be lower than that.
Sir, I think if you come closer to the mic, we can hear.
Yeah. FY24 we did about 47% was the yarn revenue, and 53% was the fabric and garment revenue. Current year we see a number going up, so yarn revenues will decrease from here.
Okay, and any ballpark number will glide for this year, or will it not be meaningful?
It is difficult to project that, but we will see a substantial change.
We will see a substantial change in this. Sir, when you alluded to the fact that our finance cost, we can analyze this 23 crore number for the current financial year?
Yes, I think this should be the peak number.
Okay, and we have, sir, current year closing balance of CWIP of 220 crore. So I think so. When will this get capitalized?
I think all our expansion plans are finishing by the second quarter next year.
Okay, then on this 220 crore पे भी sir ब्याज अलग से लगेगा, then that cost of fund, when finance cost should increase.
There are two things here. I think currently we have also not interest subsidies that are available to the company. So this we have full financials that there will be some reduction on that front. Capex will come up plus. And there are also the working capital utilization is our export limits were much cheaper 1 year back.
No, I can't hear you.
High today. So I think all these numbers factored in, we should see that we can assume that this is a peak number.
I'll rejoin, sir. I think so. I'm unable to hear.
Okay, thank you, sir. Mr. Ganesh Kumar, sir, you may go ahead and ask your question. Rest of the participants, please raise your hand for the questions.
Okay, thank you. Am I audible?
Yes, sir.
Okay. So given the capex that we are doing, how do we see depreciation and debt panning out, say, over the next 2 years or 3 years?
See, depreciation is going to go up with capex coming in. So absolute number of depreciation is going to go up, and as well debt number. We are still going to add some debt because whatever expansions are under process. So I think there is undrawn debt of about 150-200 crores on the long-term debt side. So that will add. However, current year some repayments will also happen. So there will be a slight increase on the debt, not meaningful. We can safely say that we are at least about 85-90% at the peak debt levels.
Okay, so the interest costs will also more or less stay the same.
So that's what I said that earlier, that the March quarter is probably the peak number.
Okay.
So it is interest rates don't go up from here.
Okay, got it. So just one more question. How does you addressed it earlier in the call, I missed it. So how do we see the margin difference between the value added that we have today and whatever we are trying to incorporate over the next 2 or 3 years?
See, currently we are at 10% margin levels, and we are saying that over the next 2 years we are working towards going up to 12.5%. So that is the work that is happening on that front.
Got it. Thank you. That's all from my end.
Thank you, sir. Mr. Saket Kapoor, sir, you may go ahead and ask your question now.
So sorry for the interruption, sir. You were explaining about, I think, the interest cost, the absolute number that there will be provision of the rebate on the loans drawn. So on a net basis, even on an increase of 150 crore in the net debt level, the interest costs are more or less aligned to 110 crore annual number. This should be the number we should pencil in.
Yes, I think it should be below 100.
It should be below 100. And sir, you alluded to the point that post December quarter, the margins, the yields improved on the yarns for the March quarter. Post March exits, sir, what are the trends currently for the month of April and we are mid-May right now?
So I think we are still in line with last quarter. There may be a slight improvement from that, but still it is very volatile. So difficult to give a clear guidance on that.
And sir, we are running on full utilization level, optimum capacity?
Yes, broadly.
And for the year as a whole, sir, what should be the interest rebate we should factor in?
See, currently, see how this works is when you incur a capex, you apply for under the investment promotion scheme of the government. You inform them that my project is complete and now I'm eligible for the subsidies, the interest subventions. So that has already happened, and currently I think what we have not factored in is about 4 to 5 crores of interest that will be accounted for once the government approves this. So that happens retrospectively. It will happen from the date of the project completion date. So we have some we are still, but we'll account for it once the government approves it.
That is only 4 to 5 crore rupees.
Yes, no. 4 to 5 crores is what we are for this financial year. That is what is not accounted for. So whatever permissions have been received has been accounted for. This is the number that is pending to be accounted for.
Sir, our debt numbers are long-term borrowing is 619 crore. And what is our cost of fund, blended cost of fund, taking into account both these? I think so the short term is around 446.
See, long-term debt, I think that there are some loans about 150 crores are old loans that are at about 9%. And then all the new loans that we have taken considering the government subventions, I think it should be below 5% for the long-term loans.
And working capital requirement?
Working capital is between around 8%. Blended.
You spoke about historical margins also for us and our improvement in margins. So barring the year of 22-23 जिसमें आपके margins supernatural थे पूरे segment के लिए, historically हमारा क्या EBITDA margin sustainable रहा है, and ये capex stabilize होने के बाद आप क्या expect करते हैं?
See again, ये capex सब कुछ होने के बाद हम लोग expectation 12.5% के रखते हैं. Historically, see, इसमें these numbers are considering today's yarn spreads. So if yarn spreads go up, we may improve from 12.5 to whatever number that to the extent where yarn spreads go up. Now historically, I think if we say over the last decade, I think yarn margins have always been at 10%. So if they were to come back to 10%, we may actually see 15% margins totally. But in the current scenario, on the current yarn spread, we would assume that I think 12.5% is a safe number.
So मेरे दो और प्रश्न हैं. पहला सर, firstly in the capital raising exercise, I think so we have raised some equity also earlier. So that has all been utilized for this capex part only, I think so.
Yes, that is true.
And what was the dilution, sir? At what price have we done that?
So actually, there is no dilution because if we see over the last 4 to 5 years, I think the stake has gone from 8 to 70%. There is no dilution on that front.
The last raising was fundraising was from the promoter category only or non-promoter?
Last fundraising was about 100 crores, where 60% was funded by the promoter and 40% was from a non-promoter entity.
Okay. And sir, lastly on the power cost and the other expenses, power and fuel mix हमारा क्या है? What investment are we doing in the renewable segment? And are we drawing currently? We are dependent on the state grid for our electricity requirement.
Right. So currently, majority of the power is drawn from the state grid. I think about 10% of our needs are coming from the renewable side. So there are plans to work towards increasing the renewable capacity, but they're still under very initial phases. So we'll come back to you when we have more clarity on that.
So अभी mix क्या है सर हमारा? कुछ meaningful है renewables?
करीबन 10% of our energy comes from the captive needs, the renewable side. I think
13 megawatts. PLF is 20%.
Right. So I think 10% of the total energy is from that side. Yeah, 90% is from the.
And grid का power cost क्या है हमारा?
6 rupees 80 paisa of discount and all, right?
725.
725 and then we have duty.
So 725 is the blended cost.
Blended cost 730.
And then there is this cost escalation also for next year, or 725 is fixed?
This is the current pricing in the current financial year.
They charge fuel surcharge time to time. That may be 30 paisa more, because that we know only after year. So,
yeah, but see, I think 725 is a number that we can say that is the average cost.
Average cost. It has an impact of that also. Fuel surcharge.
Lastly, on the other expenses part, sir, what are the key components for the other expenses? I think so it is 85 crore for this year. Last year also the number was only 84 crore. But Q on Q that has gone up from say 63 to 85. The turnover has increased from 621 to 701, माने around 70-80 crore. But 20 crore से 23 crore से आपका other expense बढ़ा है. तो इसको कैसे proportion में लेना चाहिए?
इसमें ऐसा होता है कि see, apart from the raw material, power and employee benefits, जो सबसे बड़े costs हैं, इसके अलावा जो costs ऐसी है, let us say, जो raw material में classify नहीं हो रही, for example, dyes and chemicals जो हमारे processing में use होते हैं. So when our fabric turnover increases, so there actually the raw material on the processing division is dyes and chemicals, but that is classified in other expenses. So एक वो बड़ा factor है जो जब turnover बढ़ता है तो ये impact इसमें आता है. तो however we have to see the overall margin expansion is 2%, almost 2% from quarter on quarter. So that is a number that has gone into other expenses. तो इसका आंसर थोड़ा दिखता है. बाकी other expenses actually are the processing costs, the selling expenses, like freight and sea freight and factory overheads and other overheads, office overheads, all those things are factored in there.
Sir, I'll join the queue, sir. मैं फिर आता हूँ line. Thank you.
Thank you, sir. Mr. Nikhil Agrawal, sir, you may go ahead and ask your question now.
Yeah, hi. Sorry, actually, I joined the call a bit late. So my question relates to the free trade agreement, the FTA. So are you seeing any green signals or some positive signs on ground that, the FTA will soon be?
I think Vice Chairman answered that question earlier. The same question was asked. So right now, because FTA government is quite active on that, and since we already closed, at a very advanced talk with the UK and Australia, but it will take some time when the new government will come into power, right? Probably it will happen in a couple of months' time. So it is on top agenda of the government.
Okay, sure, sir. That's it. Thank you.
Thank you, sir. Mr. Saket Kapoor, sir, you may go ahead and ask your question.
Sir, on the income tax rate fund, what is the taxation rate currently we are into? I think so. This year, in your cash flow, the tax paid is only 12 crore 35 lakhs.
See, the tax, we are under the 22% regime. So 22 plus surcharge, about 25%. 25% is the income tax rate. However, tax outflow is not read too much into that because a lot of capitalization has happened over the last 1 year. So the income tax depreciation, there's always be a difference.
Okay. So the net tax outgo is much lower then. We are left with more cash.
Yes, that's true. So that's because of the capitalization that has happened over the. We have gone into the new regime, I think 3 years back or 4 years back. So tax rate is 25%.
Okay, but the actual tax outgo will be in the region of this 8 to 9% only. This for this year also, we will be then saving a lot of cash will be there in the book.
We have not really worked too much on that. So let us see what that number is, because there's a lot of depreciation that is happening, and then there are some accelerated depreciation that you can take on certain products. We've not really worked too much on that number because long term the tax rate is going to be 25%.
Right, sir.
So maybe for next 2-3 years, but eventually it will catch up.
And sir, next time when you are coming up with the results and presentation, kindly allude to the point of this interest rebate part also, so that we get a clarity on what have we accrued in terms of in the other income split, as and when the same comes up. When you are alluding to the fact, because finance cost, you are saying that it will remain stagnant at or lower than 100 crore for the year, whereas we will be drawing more money into the debt account. Our net debt will peak later on with an increase of 150 crore. So next in the next presentation or during the call, kindly explain to us the benefits in terms of the actual accrual cash received that will clear, because 4 crore I am unable to understand what you were trying to allude. If it is annual 4 crore, quarterly 4, that number I missed, sir. So if you could explain one again or later one also.
Try to give you more clarity on that. However, I had answered this question in part earlier that all the new loans that we are taking for projects will be sub 5% interest costs for the term loans. So we have still about 150 crores of old debt that is pending, which is not pertinent to current capex. So that is at about 9% interest rates. The new debt will be, so right now it is, so we'll try to give you a more accurate number on the next call, that how much of the new debt where the approvals from the government has been received, which has been accounted for at that rates, and how much is still pending. So I give you absolute number that about 4 to 5 crores is the number that we have not accounted for. We are waiting for government approvals. So that is pertaining to the current financial year, which will be actually accounted in the next financial year. But I will try and give you a better picture next time.
And sir, on the dividend part, yeah, please. You're telling something. On the dividend part also, sir, we have maintained our dividend at 20%. So, what should investors look at in terms of the dividend payout ratio? Is how have you arrived at a figure of 20%?
So we just tried to maintain continuity. Last year, it could have been a higher number, but since we could see that margins are going to be under pressure in the future, so we tried to be conservative last year, and this year we tried to maintain some continuity there.
But we should work, sir, for a codified dividend policy rather than things in which you are working on how the market conditions will shape up. There should be a codified way. If there's better profitability and if you adjust your current maturities as per your cash flows, it should be codified in that way. It should not be ad hoc that you are taking a conservative view or an aggressive view when you are declaring dividend. That is a understanding.
So, point taken. We will try to work on that policy.
Right, sir. And for the exceptional item, sir, note number 4, I'll go through. Would you like to explain, sir?
So this is with regards to the ESOPs and sweat equities that were issued to various company officials, I think 2 years back. So that is going to be amortized over 5 years. So I think that exceptional item is part of that cost.
That is a non-cash item.
Yes.
Thank you once again, sir.
Thank you, Mr. Saket Kapoor, sir. Mr. Ganesh Kumar, sir, we can take up your question. Please go ahead and ask the question.
Thank you. Am I audible now?
Yes.
Yes, sir.
Just a couple of questions. We have had 2 fundraisers, I think, through preferential warrants and conversion to equity in the last 4 years or so. Do you anticipate any more equity dilution because of any new preferential warrants or conversion of previous warrants in the next 2 or 3 years?
No, we are well capitalized, and all our projects have been funded through debt or equity. So I think we are very comfortable there. We don't foresee any further equity infusion in the company in the near future.
Okay. This question you probably partly answered earlier. I just wanted to clarify. So what will be the power cost for us annually? Just a ballpark figure.
The per unit cost is about 7.25 rupees per unit. Absolute number, difficult to say because it obviously depends on the capacity utilizations and with new capex coming in. So absolute number will go up. Per unit cost is that. However, percentage of the revenue should remain similar.
Okay. So today, as a percentage of revenue, can we say it's around 8 or 10%?
Yes, I think it is around that number. Yeah.
Okay. Thank you. That's all from my side.
Thank you, sir. Participants, whoever wants to ask a question may raise their hand.
So look like there are no further questions. We'll stop the. Anurag, you want to give any closing comments before we stop?
No, so thank you everyone for joining the call today. We trust we have addressed all your inquiries to your satisfaction. If you have any remaining unanswered questions, please don't hesitate to contact us or our investor relations agencies, Go India Advisors. They will be more than happy to assist you further. Thanks again. Thank you.
Everyone.
The recording has stopped.
Thank you, everyone. Thank you, Anurag.